Have you ever wondered how people actually make money from the stock market? Or why a company's stock price changes every day? In this video, I'll break down how the stock market works in simple terms. So, what is the stock market? Imagine this, you're at a giant, never-ending auction. Except instead of bidding on art or antiques, you're bidding on tiny pieces of real companies, like Apple, Tesla, or even Coca-Cola. That's the stock market. It's a marketplace where people buy and sell ownership in companies, and these ownership pieces are called stocks, or shares. Every time you hear someone say they bought shares of Amazon, they've literally purchased a small ownership stake in the company. But here's the twist. The prices of these shares are constantly moving. Why? Because it works just like an auction. When more people want to buy a stock than sell it, the price goes up. When more people want to sell than buy, the price drops. And all of this happens through stock exchanges, kind of like the giant digital marketplaces where these transactions take place. You've probably heard of a few of them: the New York Stock Exchange, NASDAQ, and the London Stock Exchange. These are where public companies are listed. Now, what does public mean? When a private company wants to raise big money, they can go public, meaning they sell a portion of their ownership to the general public in exchange for cash. This process is called an IPO, or initial public offering. It's like Shark Tank, but instead of a few investors offering funding, millions of everyday people can invest in the business. Once listed, the company's stock can be bought and sold by anyone with a brokerage account. And from that point on, the company doesn't control the stock price, the market does. So in simple terms, the stock market is just a giant digital auction where companies sell ownership, and investors trade those pieces based on what they think they're worth. Supply and demand run the show, and that's what makes it exciting and unpredictable. All right, now that we know the stock market is where companies are traded, let's talk about the star of the show, stocks. A stock is simply a piece of ownership in a company. Yup, when you buy a stock, you're literally becoming a part owner of that company. Let's say a company has 1 million shares. If you own 1,000 of them, congrats, you own 0.1% of the company. You probably won't get to make big decisions or park in the CEO's spot, but you're legally an owner. Not all stocks are created equal. Let's break it down. Common stock. Most people own this type. You get voting rights at shareholder meetings. You may receive dividends, a small slice of the company's profit. Preferred stock. No voting rights, but you're first in line for dividends. If the company goes bankrupt, preferred shareholders get paid before common ones. Think of it like flying on a plane. Common stock is economy class. You still get to your destination. Preferred stock is business class. More perks, but fewer choices. Blue chip stocks are large, stable, trusted companies. Think Microsoft, Johnson & Johnson, or Coca-Cola. They've been around, they pay dividends, and they grow steadily. Penny stocks are cheap, often under $5, but high risk. These are small companies that might explode or completely disappear. So while a penny stock can 10x overnight, it can also hit zero just as fast. Here's the key question. Why would a company give away pieces of itself? The answer? Money. Companies issue stock to raise capital, cash they can use for growth, like opening new locations, expansion, like going international, research and development, like building the next iPhone. Instead of taking out a massive loan, they share a piece of the pie, and in return, they get the fuel to grow even bigger. So when you buy a stock, you're not just gambling on a price, you're investing in the future of a business. You're putting your money behind a company's ability to grow, thrive, and turn a profit. And that is what makes stocks so powerful. So you might be wondering, why does a stock price go up one day and crash the next? Great question. The answer is simple and chaotic. Supply and demand. Every stock has a price, but that price isn't set by the company. It's set by what buyers are willing to pay and what sellers are willing to accept. If a lot of people want to buy a stock, but there aren't many willing sellers, the price goes up. If a lot of people want to sell, but buyers are hesitant, the price goes down. Think of it like eBay. If everyone's bidding on the same item, the price skyrockets. Let's say Tesla announces record-breaking profits and a brand new model. The news hits, investors get hyped, and thousands rush to buy shares. Demand spikes, price goes up. But let's say a week later, Elon tweets something weird again, or a factory fire makes headlines. Confidence drops. Everyone starts selling. Boom, stock drops. Same company, different sentiment. Stock prices don't just move randomly. There are actually a few key things that cause them to rise or fall. First and foremost, it's about how the company is performing. If a business reports strong earnings, growing sales, or launches a hot new product, investors usually take that as a good sign, and the stock tends to go up. On the flip side, if profits are down or the company misses expectations, people might start selling and the price drops. But performance alone isn't the whole story. There's also market sentiment, which is basically how people feel about a stock. A positive news article, a viral rumor, or even one tweet from the CEO can get investors excited or freak them out. Then you've got global events. Things like inflation, rising interest rates, wars, or pandemics can shake up the entire market, even if your favorite company is doing just fine. Investors hate uncertainty, and global shocks usually make people nervous. And finally, let's be real, a huge part of the stock market is just pure emotion. Fear and greed move markets just as much as facts do. Sometimes prices go up simply because everyone thinks they'll go up, and other times, people panic for no solid reason at all. The stock market isn't always logical. Sometimes, a stock goes up even when the company is doing nothing special. Other times, great companies fall because of panic. It's not just about how a business performs, it's about how people think the business will perform in the future. That's why expectations drive everything. If more people want to buy, price goes up. If more want to sell, price goes down. That's the market. Unpredictable, emotional, and fascinating. So you're probably thinking, cool, I get what stocks are, but how do I actually make money from them? Great question. And here's the simple truth. There are two main ways investors make money in the stock market, and both can be extremely powerful when used right. Let's start with the obvious one, capital gains. This is when you buy a stock at one price and sell it later at a higher price. The difference between what you paid and what you sold it for, that's your profit. Let's say you bought 10 shares of Tesla at $200 each, so you spent $2,000. A year later, those shares are worth $300 each. Now your investment is worth $3,000. If you sell, you've made a $1,000 capital gain. It sounds easy, but here's the catch. Stocks don't move in a straight line. They go up and down, sometimes for logical reasons, sometimes just based on emotion or hype. And if you panic and sell during a dip, or chase a stock that's already overhyped, you could lose money just as fast. That's why most serious investors don't just rely on price swings. The second way to make money is through dividends, and this is where things get really interesting. Some companies, usually big, stable ones like Coca-Cola, Apple, or Johnson & Johnson, actually share their profits with you, the shareholder. Every quarter, they send out a payment called a dividend just for owning their stock. It's like this. Imagine owning part of a business, and every few months the business sends you a check because you believed in them enough to invest. Now, the amount might seem small at first, maybe $1 or $2 per share per quarter. But if you own hundreds or thousands of shares, those dividends can really add up. Some people even live off their dividend income in retirement. It's not flashy, but it's consistent, and you don't even have to sell the stock to earn it. Now you might be wondering, should I buy and sell stocks quickly to make fast gains, or should I hold long-term? Well, short-term trading, like day trading or swing trading, can look exciting, but here's the truth. Most people who try to time the market end up losing money. Why? Because you're trying to predict something that's unpredictable, and you're competing with professionals, hedge funds, and algorithms that make trades in milliseconds. Long-term investing, on the other hand, is boring, but powerful. If you had bought just $1,000 of Amazon stock in the early 2000s and held on to it for 20 years, you'd be sitting on hundreds of thousands today. Because when you invest long-term, you're not just hoping to catch a lucky spike. You're investing in businesses that grow, innovate, and expand over time, and your wealth grows along with them. So whether it's through capital gains, dividends, or both, the stock market is a tool for building wealth. It's not a lottery ticket. It's not a game. It's ownership. And the more patient and informed you are, the better your results will be. All right, by now you're probably thinking, okay, I get how the market works and how money is made, but how do I actually buy a stock? Where do I even go? You don't walk into Apple headquarters with a bag of cash and ask for shares. To buy or sell stocks, you need a broker. And in today's world, that usually means an online platform or app that connects regular people like you and me to the stock market. Think of your broker like the middleman, or the bridge, between you and the stock exchange. In the past, brokers were people you had to call on the phone, guys in suits shouting trades across a room. But now, it's all digital. You just open an account on a platform like Robinhood, eToro, Interactive Brokers. Depending on where you live, some platforms are more popular than others. They make the whole process super simple. Once you're signed up, you can search for any stock, like Google, Amazon, or even a smaller company, and buy shares right from your phone. You can start with as little as $10 or $50, depending on the platform. Many now offer fractional shares, so you don't need to buy a full $3,000 stock if you don't want to. Now, when you place a trade, you usually choose between two main types of orders. 1. Market order. This buys or sells the stock at the best available price right now. Fast and simple. 2. Limit order. This lets you set the price you want to pay. Your order only goes through if the stock hits that price. So if Tesla is at $250, but you only want to buy it if it drops to $240, you'd set a limit order at $240. If it never hits, your order just sits there. Most brokers are regulated and insured, but it's always smart to use a well-known, trusted platform. And make sure your account is protected with two-factor authentication, just like your bank account. Because yes, you're dealing with real money now. So in short, you don't need to be a Wall Street expert to invest. All you need is a phone, a few bucks, and a basic understanding of how to use a broker. The tools are in your hands, literally. There are a lot of myths and misunderstandings about the stock market, and if you believe them, they can cost you. This one comes up all the time, and I get it. Prices go up and down, people make or lose money fast, it feels like luck. But here's the truth. Gambling is based on chance. The house always wins. Investing, on the other hand, is based on ownership, strategy, and time. If you invest in strong companies or index funds and give it time, history shows you're likely to make money. In fact, over the past 100 years, the S&P 500, which tracks 500 of America's biggest companies, has returned an average of 7 to 10% per year after inflation. That's not luck, that's value creation. Here's the thing, they don't, at least not all the time. Markets crash, recessions happen. In 2000, we had the dot-com bubble. In 2008, the financial crisis. 2020 brought COVID chaos, and there will be more. But the market has always recovered and gone on to hit new highs. The people who panic and sell during dips often lock in losses. The people who stay calm, hold strong companies, and keep investing, those are the ones who win long-term. Now let's talk about the biggest risk for new investors: FOMO, the fear of missing out. You see a stock exploding on TikTok or Reddit. Everyone's getting rich. You jump in at the top and boom, it crashes. That's not investing. That's chasing hype. And then there's day trading, buying and selling stocks quickly to try and time the market. Sure, it looks fun, but unless you have years of experience and nerves of steel, you're more likely to lose money than make it. It's not the market. It's you, your mindset, your emotions, your lack of patience. The best investors, they research. They stay calm. They think long-term. They don't react to every dip or every headline. They treat the stock market like a business, not a casino. So no, investing isn't gambling. But if you treat it like a game, you'll probably get played. So there you have it, the stock market, broken down in simple terms. It's not some secret club for the rich. It's a tool, a powerful one. And if you learn how to use it, stay patient, and play the long game, it can completely change your financial future. If you got value from this video, do me a favor, hit the like button, subscribe, and turn on notifications so you don't miss the next one. And let me know in the comments. What's one thing about the stock market that still confuses you? I read every reply, and your question might be the topic of my next video. Thanks for watching, and remember, in investing, time and knowledge are your greatest assets.